Superannuation is an essential source of income for almost all Australians in retirement. But did you know that a lot of people end up suffering later in life because they don't understand the optimal way to structure their income? In this video, I'm going to explain how drawing an income from your super works, the optimal way to do it, and at the end of the video, I'll also go through the common traps retirees fall into that lead to big problems later in life they never anticipated. So what we're talking about today is an account-based pension, and there is a lot of confusion around this. An account-based pension is completely different to the age pension, and it's what's commonly known as a retirement income stream that uses your superannuation balance. It turns all that capital you've saved and put away throughout your entire working life into regular payments to replace your salary. The difference between account-based pension and an age pension is that the account-based pension requires you to take market risk. That is, the income that you receive from the pension is going to be determined by the value of your assets and the performance of your assets. But ultimately, what you're doing is converting all that savings into an income source that replaces your salary and getting some benefits out of that. Historically, these pensions have been known as a few different things. One of those is an allocated pension, another is a transition to retirement pension. So the first question we have to ask and answer is, when can you start an account-based pension? As we know, superannuation is preserved. That means you need to meet a condition of release before you can access your superannuation balance. The most commonly met condition of release is turning 65 years of age. And while Australia doesn't have a retirement age, 65 is as close as you would consider to be a retirement age. Alternatively, and we've got a lot of comments and a lot of questions around this from previous videos, is that if you cease an employment arrangement after attaining 60 years of age, you may also be able to meet a condition of release and therefore start drawing an account-based pension from your superannuation assets. Once you've met a condition of release, you can start this pension at any time you like. Now, before we move on to how to do it and the drawbacks of it, we want to talk about the benefits. And there's one big massive benefit of this, and that is that once you start drawing a pension from your superannuation balance, that entire balance becomes exempt from tax up to a cap, as we've talked about in previous videos, of 1.9 million as of 2025. What does that mean? That means the income tax that you were paying while you're contributing and capital gains tax you're paying while you're contributing, which is 15% within superannuation, which is also lower than what you would pay if you're investing in your own name, goes to zero. You turn your superannuation assets into a completely tax-exempt and tax-free environment. And that's because the government provides this benefit to assist people and encourage people to fund their own retirement. What does that mean? If you're looking at an industry fund, it means if you compare the accumulation account versus an income or income stream account, the return will be slightly higher from that income stream account because of that reduction in tax. For an SMSF, it means you can convert your superannuation balance to paying tax 1 year to having a significant refund of any franking credits and any other deductions that you've had through the superannuation fund. The other benefits, because it's an account-based pension, you can decide how much you get paid. There are some legislated minimums that you have to draw each year, but you decide how much you get paid and when. If you want to be paid weekly or monthly, if you want to be paid $50, $60, $70, $100,000 from your assets, you can determine that, and you can determine how it best suits you and your family. So you can structure it exactly to suit your needs. One of the other benefits is that you are able to both switch on and switch off this pension when you need to. Not that that's something that many people do once you've got those taxation benefits. They can also be diverted to your surviving spouse or minor children on your death, which is something we'll discuss around estate planning in a separate video. And the final benefit you get from commencing a pension from your superannuation assets is that not only is all the income and capital gains generated within your superannuation fund tax-free, any benefits you take after you turn 60, which is the majority of people now, is also tax-free. All your superannuation balance becomes completely tax-free. Now let's switch over to the downsides. And we discuss this in the introduction, and that is that an account-based pension is market-linked. That means your income will only last as long as your investments and as long as your assets continue to grow. You are forced to draw a minimum income each year, and I'll talk about that in a second, which means sometimes you're forced to take more money out of superannuation than you're spending. And I think it's important here that you distinguish between the fact that you have a minimum amount of income you need to draw to satisfy that pension and keep the tax exemption, but that doesn't have to be the amount that you're spending in your own name or the amount of expenses that you have. You can easily save that. In some cases, contribute it back to superannuation or continue to invest in your own name. Another drawback is that you can only get $1.9 million into that pension phase. Obviously, that doesn't impact everyone, but there is a cap to how much of a tax exemption you get. It is included in age pension assessments. So once you trigger and start drawing a pension from your superannuation assets, it will be included in an assessment for how much age pension you're entitled to. But ultimately, the biggest risk is longevity and investment. That is that the assets that you have can't support the level of income that you're drawing And as a result, you run out of money from that superannuation balance before you pass. So the drawback, which isn't really a drawback, it's just a guide and a requirement from the taxation office, which is that in order to keep a tax exemption on those superannuation pension assets, you must draw a minimum portion of your balance each year. Now, for those under 65, so if you're 60 plus, you need to draw 4% of your balance calculated as of 1 July the previous year. For example, if you had $1 million in pension, you'd have to draw $40,000 in that year, and you have to draw that before the end of the financial year. Once you turn 65, that goes up to 5%. Once you turn 75, that goes to 6%, 80 to 7%, 85 to 9%, 90 to 11%. Once you get over 95, 14%. So essentially, the system is encouraging you to get more money out of superannuation and into a taxable environment. But as we said, there is still the ability to continue to contribute to superannuation until you're 75, and these days without meeting a works test. The common question we get, is there any tax on pension payments? If you're over 60, no, there's no tax on pension payments. If you're under, which is very rare these days, but in some cases it is possible, potentially from an insurance payout, then it will be included in your taxable income. The taxable component of that amount will be included in your taxable income, less of rebate. Now, when it comes to Centrelink, as I was referring to earlier, the account-based pension will be included in both the assets test and the income test when calculating your entitlement. The entire balance supporting that pension will be included in the asset test, and then you'll deem to have produced an income under the standard deeming rules based on that asset base, and that'll be included in your income test as well. So it's always important to consider that. And financial advisors can be quite good at timing of pensions, particularly when there's an age gap between members of a couple, and potentially maximising your age pension in that period. Now, the most common question we get, and probably the most straightforward for us to answer, is how do you start a pension? In every case, it's just paperwork. If you're an industry super fund, you need to go on the app and complete a form that changes your account into an income stream. Now, it's important to keep in mind that one of the drawbacks is that once you commence that pension, you can't add to it. You can't contribute to that pension account. You would need to then open a new account and make contributions into a new accumulation account. You can pull that pension back into accumulation and put more funds into there. But generally, once you start a pension, you can't add to it as a general rule. For SMSFs, you need to speak to your advisor or your accountant. But ultimately, again, you're completing another set of paperwork, a series of minutes, a number of forms to sign, all of which allow you to calculate the balance of how much you're going to get paid, when you'd like it to be paid. And in every case, if you commence a pension outside of 1 July, so at any other time during the year, the minimum pension will be prorated based on the number of days left in that year. The key here is it's important to meet the regulatory requirements and make sure that you're always drawing at least the minimum and you're checking that before 30 June each year. The final questions we get around pensions is, should you start? And my answer to that is, in almost every case, is yes. The tax saving and the returns and the additional returns that come from that tax saving are anywhere from 1% to 3% every year. You can usually recontribute a portion back into superannuation where you're between 60 and 75, which means even if you don't need it, it can still be beneficial to be drawing that pension once you've met a condition of release. And there's no tax on the income. So you can see this becomes a bit of a no-brainer. It also gives you flexibility to gain access to all of your superannuation assets, which if you wanted to, you could cash out completely. Now, at the beginning of the video, I said I was going to highlight a few mistakes that people make. And I think the biggest one I ever see is that many people forget to even start a pension. And there's a number of stats around and reports around that show a lot of members of industry funds, as opposed to self-managed super funds, don't even start a pension even though they're over 65 years of age. So the tax benefits are significant. So the first one is always look at starting a pension as soon as you've met a condition of release. An issue I see is that when people head to retirement, because they aren't informed, because the information hasn't been provided to them, they just end up taking money out of superannuation altogether and putting it into a taxable environment. And they could be thousands and thousands of dollars worse off every year. And probably the final one, and something we've covered in a separate video, is that too many people invest for income and not income and growth when they're starting to draw a pension. If you're investing for income, or if you're only investing in low risk investments, the risk is that your income you're drawing is more than the income and growth that you're producing, and therefore your money is going to run out quicker. So once you start that pension, longevity and growth, and as we've talked about, retirement can be anywhere from 20 to 35 years for the majority of us. So the key there is always investing for both income and growth and balancing those to make sure you don't outlast your money outlasts you. Thanks again for listening. Please subscribe to the channel. Please send through any questions. Appreciate all the comments. And if you're looking for advice or recommendation on how to start a pension, please reach out directly.